Now, since 2019, I've been able to build a £4 million property portfolio by buying properties like this purely because of the strategy of property refinancing. This is how it works step by step. In 2020, I bought this one-bedroom flat in West Hampstead in London. I bought this for £303,500. I then got a 75% mortgage on that property. So I essentially borrowed 75% from the bank, and that came to £227,625 as the mortgage loan. I then put down 25% myself, which was £75,875. On top of the 25% deposit, I also had to pay stamp duty, which is a tax you pay when you buy the property. I had legal costs, I had finance costs, and I also completely refurbished the property, and I converted it from a one-bedroom flat into a two-bedroom flat. Now, all of that came to £84,883. So now, the total amount of money that I've put in myself is £160,758. Once the property was completely modernized and it was converted into a two-bedroom flat, we then got a new bank to come and value that property, and they valued the property at £450,000. My all-in cost is £388,383, which means I've made a profit of £61,617. Now the problem is, yes, you made £61,000, but if you want to get that money out and you sell the property, you then have to pay sales fees, you have to pay legal fees, you also have to pay taxes because of the profit you've made, and all of that starts to erode the amount of money you've made in the process. So once the new bank valued the property at £450,000, rather than me just selling it, I then got a new mortgage of 75%, which was £337,500. So the new bank has essentially given me a 75% loan on that property. But I still owe the first bank when I bought the property they're £227,625. So I then take my £337,500. I then repay the first bank, which is £227,625, and I'm left with a difference, which is £109,875. Now, if you think about it, when I bought this property and I refurbished it, I ended up spending £160,758. But when I refinanced it, I got back £109,875. So really the property's only cost me around £51,000 because I've got the bulk of my capital back. So this way I can release a lot of the money I've made without having to sell the property. Now you might be thinking, well, where exactly has this money come from if you still own the property? And really what's just happened is that your initial mortgage was £227,625. Your mortgage has now gone up to £337,000. You've essentially borrowed another £110,000 in the middle. Now you might be thinking, well, hold on, do I really want to borrow more money? Now I owe even more money to the bank, and surely that's a bad thing. So now let's compare those two cases. The property is worth £450,000. Let's say the property rents for £2,000 per month. So if you had the initial mortgage of £227,000, your monthly mortgage payments might be around £949 per month. Now because you've remortgaged and you've borrowed even more money, and your mortgage is £337,000 per month, your mortgage payments are around £1,407 per month. So yes, your profit overall has come down because your mortgage cost has gone up, but in both situations you're profitable anyway, so it doesn't really matter too much. But by borrowing more money, you have another £110,000 cash, and you can use that to buy even more investment properties. So if you look at house prices, over the years, they've just been going up, up and up. So with that £450,000 property, let's say your initial mortgage is £227,000 and then you pump it up to £337,000. But if property prices continue to go up, up and up over the years, and then 30 years later, 20 years later, whether your mortgage is 227 or 337, the property is still worth significantly more than what the mortgage amount is. And so once again, you're profitable in any case. The £110,000 you borrowed in the middle, that I believe is good debt because that allows you to buy more investment properties, which make you more monthly cash flow every single month, and they appreciate over the years. But even putting that aside, this is by far the single biggest benefit of refinancing the property rather than selling the property. So now once again, we have the same scenario, and let's say you had a profit of £61,617. Well, if you then sold that property, you'd pay a 20% tax. That comes to £12,323. And so you're actually left with a post-tax profit of £49,294. I haven't even taken off, sales fees, legal fees, all that stuff. So that £49,000 would normally be eroded even more. But now let's compare that to if you refinance that property. So in this situation, when you got £109,000 back, that £109,000 is not income, that is a loan, because you're essentially borrowing more money from the bank. And when you borrow money, you can't get taxed on that income because it is a loan, it is not your income. So all of that £109,000 is completely tax-free. So now every single time that property appreciates in value, let's say in 10 years time it's worth £650,000, £750,000. Every single time the property value appreciates, you just refinance that property, you borrow more money against it. Every time you get that money money out, it is completely tax-free because it is a loan and not your income. And so as property prices appreciate, you can take that money out without paying any tax, whereas if you were to sell that property, not only have you lost the property, you then also have to pay tax on the amount of money you've made over the years. By the way, before you commit to any of these strategies, make sure you speak to a professional who can guide you based on your financial situation, your income, your affordability. You don't want to get into something which might impact you negatively financially. Unbiased is the personal finance platform which helps you make confident financial decisions. So whether you're looking to get the best mortgage rates, running a small business, or planning for retirement, searching for insurance, Unbiased has you covered. Unbiased has been a trusted name in the UK for over a decade, connecting millions of people to financial advisors, mortgage brokers, insurance brokers, and accountants. Unbiased works with 27,000 financial advisors, so you can be sure you'll get someone who can tailor advice based on your specific circumstances and your specific needs. You just have to answer a few questions and you'll be matched with an advisor within 24 hours. Now, once you're matched, your first consultation is completely free with no obligation to continue if you choose not to do so. Click the link in the description below and make sure you seek professional financial advice before you commit to any sort of financial investments. Because recently interest rates have gone up, there are some things to consider before you decide if you want to refinance your property, because there are some downfalls. The first thing I said is when the property value goes up, you can just refinance at 75% loan to value and get a lot of your money back. Now, you might not be able to refinance at 75% loan to value, depending on the property, depending on your area, because of the fact that the mortgage rates have gone up. Because the rates have gone up, it means the rental stress testing on investment property also has gone up, which in simple English basically means that the rent on the property might not be high enough to meet the stress test calculations of that mortgage. So what that means is you might not be able to refinance at 75%, you might only be able to refinance at 70%. The easiest thing to do is just speak to a mortgage broker. If you want an introduction to mine, I'll leave his details in the description below. Get in touch with a broker, send them your investment property, tell them what the rent is, and ask them what is the maximum amount I can borrow on this property. The second thing is, let's say you have a mortgage right now and you only are paying around a 2% mortgage rate. If you refinance that property right now, you're very unlikely to get another 2% mortgage because of the fact that the rates have gone up. So if you're on a fixed term mortgage and you still have a few years until you have to refinance, you might just want to hold on until the rates come back down again. Your mortgage costs are going to shoot up and your cash flow is going to take a bit of a hammering. And then the final thing is, if you currently have a mortgage, it depends what kind of mortgage you're on. So typically speaking, there's three types of mortgages. You have a variable rate mortgage, a 2-year fixed mortgage, and a 5-year fixed mortgage. A variable rate mortgage means that your rate is variable and it changes as the Bank of England base rate changes. A 2-year fixed means your mortgage is locked in for 2 years, and a 5-year fixed means your mortgage is locked in for 5 years. Most mortgages typically have a thing called ERCs, early repayment charges. So let's say last year you got a 5-year fixed mortgage. Well, if you try to refinance that property right now, it's gonna have some sort of penalty you have to pay in order to refinance early. Typically, the longer the fixed period of a mortgage, the higher that penalty is going to be. And so if you end up refinancing that property, you will also have to pay for that penalty. And so if the property value hasn't gone up by that much and you're also paying a penalty, it might not be worthwhile for you to refinance that property right now until that period ends where you no longer have early repayment charges. Now, in order to get around this, if you want to be in a situation whereby you're buying investment properties, adding a lot of value, and you want to refinance your funds as quickly as possible, just like I did with my West Hampstead deal, where I refinanced in 6 months' time and got £109,000 back, then you shouldn't buy a property on a mortgage. You should buy it using a bridging loan, because a bridging loan does not have any early repayment charges. So you can simply buy a property, add value, and refinance pretty much straight away. You normally have to wait around 6 months, but that massively speeds up the process of you getting your money back as quickly as possible, and then using that money essentially to buy the next property, then repeating that process and then using that to buy the next property.